Our next presenter will be looking at the topic of monitoring Basel III from a data perspective. Please join me in welcoming Mr. Neil Esho, Secretary General, Basel Committee on Banking Supervision, to the stage. Thank you, Neil.
Well, thank you for the introduction, and many thanks to the Hong Kong Monetary Authority for organising this conference. Special thanks to Eddie and Arthur and all his staff over the past few days for hosting us, the Basel Committee. You've done an absolutely outstanding job. And even up until this morning, your staff have been helping me, Arthur, because when I arrived this morning, I realised I'd forgotten my speech in the hotel room, and Karita finally managed to go and collect it for me. So whether that's a good thing or not, I don't know. It'll depend on what you think of the speech. And just to emphasise the fact of how good your staff are in terms of risk management, Arthur, she didn't print one copy, she printed two and kept one herself, just in case I was silly enough to also lose this version. So thank you very much. There's one other thing I should start by saying is I'm not going to say anything about a positive, cycle-neutral, counter-cyclical capital buffer. In every speech I give, I always try and avoid that because I have such trouble actually saying the term. It's like, we really need to come up with a better term. In the time I have today, I actually plan to do two things. Firstly, I want to review progress the global banking system has made towards implementing Basel III. And I want to assess that progress, by looking at the data the committee collects through its semi-annual Basel III monitoring exercises. Normally we look at this data when it comes out, once every 6 months, but we never really take a step back and look at the history of the data. So that was the motivation for this presentation. I should say, though, that the data I will present is historical and is highly aggregated by region. So the most recent data points will be from June 2022. So the aim, therefore, is to reflect on more longer-term developments and trends rather than comment on recent events. After doing that, I will spend a few minutes just outlining the committee's current work program. Clearly, we will need to take stock as a committee of recent events and the implications for the committee's work program, but it's still too early to do that now. Nevertheless, recent events have highlighted the importance of a resilient global banking system, which is underpinned by strong risk management, robust regulatory standards, and effective supervision. Since the great financial crisis, the Basel III reforms have helped the global banking system absorb different shocks and continue to lend to creditworthy households and businesses. And since 2011, the key measures of banks' capital resilience, the leverage ratio and risk-based common equity Tier 1 ratio have roughly doubled, and moreover, the liquidity risk profile of banks has also significantly increased. This increased capital, liquidity and operational resilience of the global banking system is critical, but regulation alone is never enough. Banks and supervisors must remain vigilant and take actions to address emerging risks. So with that as introduction, let me start with a bit of a historical overview of the data. These were just my key messages, which I've already covered, so let me jump straight to the data. I'm going to present a series of charts that are all based, as I said, on the Basel Committee's monitoring data. All the data is available on the BIS website, and it goes back to 2011. The charts will broadly cover overall capital resilience, drivers of risk-weighted assets, and liquidity resilience. As I said, the data is highly aggregated and it covers 3 regions: the Americas, Europe, and the rest of the world. The one thing I concluded after preparing this presentation is that we need a better term for the rest of the world. The rest of the world comprises Asia, the Middle East, Australia, and South Africa. So if anybody has a better term, I'm willing to change every Basel Committee publications after this if you can come up with a better term. But as you can see, the rest of the world in some sense has become most of the world. I'm not sure if that's the right description, but it is, I think, factually correct. The sample of banks in these charts varies, but they're always based on what we call Group 1 banks, and these are internationally active banks with at least 3 billion euros in Tier 1 capital. Throughout this presentation, I'm going to refer to two sets of Basel standards, current Basel standards, or current Basel III, and final Basel III. So let me just at the outset define what those terms mean. The initial or current Basel III refers to the set of reforms initially published in 2010, and they include changes to increase the quantity and quality of capital, the introduction of the leverage ratio, the liquidity framework, the counter-cyclical capital framework, and initial changes to the market risk framework. They also include the GSIB framework. When I refer to the final version of Basel III, that's referring to all the changes that we introduced, that were announced in 2017 and are just being introduced from the start of this year. And they include the constraints on the use of internal models, the revised standardised approaches, the output floor, and the higher leverage ratio requirement for GSIBs. Okay, so with that as background, let's look a little bit more closely at the data. This first chart presents just overall measures of Tier 1 capital, the left panel, total risk-weighted assets, which is the middle panel, and total accounting assets, which is the right-hand panel. The pink area is Europe, the Americas are shown in blue, and the rest of the world in yellow. The percentages in these charts just show you for each region what the numbers were at the start of the sample period and the end of the period. So it's a pretty striking pattern. There are some clear trends over the past 10 years. Whether you measure, whether measured by Tier 1 capital, risk-weighted assets, or total assets, the share that is accounted for by the rest of the world has jumped considerably from around a third to around a half, and this increase has been offset by declines in the Americas in blue and a slightly greater decline in Europe, which is the red. Okay. The next two charts show you the components of minimum risk-based capital requirements. Again, the percentages show the values at the start of the sample period and at the end of the period. So, for example, if we look at credit risk, it accounts for 86% of minimum risk-based capital requirements at the start of the sample period back in 2011, and by the end of the sample, it covers 75% of risk-weighted assets. The key thing to note here is if you take credit and operational risk together, they account for about 90% of minimum risk-based capital standards, and that hasn't really changed much over the last 10 years. It is striking, I guess, but perhaps not surprising for anyone in the Basel Committee at least, that the market risk percentage of risk-weighted assets is almost negligible in terms of this chart. It's a very small percentage of minimum capital requirements. So when we think about banking risk, a lot of it, in terms of risk-weighted assets at least, continues to be the traditional credit risk and operational risk. The right-hand chart, the right-hand panel disaggregates the sources of credit risk, and the key three components here of credit risk are exposures to corporates, retail, which includes mortgages, and other, which includes a range of different types of assets, and where we don't have data to totally disaggregate. The most significant change over the past 10 years here has been a very steady increase in the importance of exposures to corporates in determining minimum capital requirements. So the number's gone from 38% to 50 or to 49%. This slide, the next slide, shows a key metric of bank resilience, which is the common equity Tier 1 ratio. I think it's important here to mention, in light of recent events, that this does not include AT1, additional Tier 1 instruments. This is common equity Tier 1. And it is the measure that, you know, most supervisors, I guess, and a lot of people in the market really focus on. The top part of the table shows the common equity Tier 1 ratio by region at 3 dates, so 2011, 2017, and then 2022. And then the bottom part of the table shows the change in this ratio. The green shaded row shows the change in basis points over the full period. And as you can see, and I think without question, there has been a very significant increase in CET1 ratios over the sample period. So the point about the banking system being more resilient is very definitely supported by the data. The increase in Europe has been the greatest by 800 basis points, 600 basis points, around 800 basis points in Europe, around 600 basis points in the Americas, and 330 basis points in the rest of the world. What is also clear in the two rows below the green shaded row is that most of this progress actually occurred between 2011 and 2017. So if you look at that change, 2011 to 2017, basically that's when all the increase in resilience occurred, and since 2017, things have basically stabilised. This next table shows the transition to Basel III and makes the distinction between the initial Basel III and the final Basel III framework. This data only goes back to 2017 because that's when the final sets of reforms were finalised. And it differs slightly from the earlier slide, but the difference in sample doesn't change the conclusions. The picture for initial Basel III CET1 ratios is basically unchanged. Since 2017, there has been some increase in Europe and the rest of the world, and a slight decline in the Americas. So overall, a very stable picture. The same picture emerges when comparing the final Basel III ratios. So there's been a slight increase in Europe and the rest of the world since 2017, and a small decline in the Americas. The table also shows the gap. So this is the gap. This is again the green shaded rows. It's the gap between initial and final Basel III ratios at 2 points in time. The top panel is 2017, and the bottom panel is 2022. So there are 2 points I would like to make about these gaps, and one needs to be careful in how you interpret this data. First, the gap between the initial and the final Basel III ratios has actually increased in the rest of the world and Europe, but declined in the Americas. So if you compare the top shaded green row to the bottom one. So to me, this suggests that actually some portfolio adjustment has occurred by banks to reflect the forthcoming changes in standards, but that only seems to have happened in the Americas so far, but not elsewhere. Secondly, and I think this is an important point from my perspective, is to emphasise that these gaps don't necessarily need to be filled, in a sense. There needs to be a recognition, and this is a difficult point to communicate, but there needs to be a recognition that an 11% common equity T1 ratio based on the final Basel III capital ratio, for example, represents a very much higher level of resilience than an 11% CET1 ratio under the former standard. So looking at the headline numbers is important, but you also need to recognise what's going on underneath. The final Basel III standards are significantly raising the quality of those ratios. So we should also be mindful of that. But that conclusion only applies, of course, if Basel III is implemented fully and consistently. Let me now turn to another key measure of bank resilience, and this is the leverage ratio. The picture here is actually very similar to the risk-based measure. We've had a very significant increase in bank resilience from 2011 to 2017, and then a relatively stable picture since then. Again, if you look at the columns with the changes, most of the changes occurs between 2011 and 2017, and after that, things have been relatively stable. The one area that stands out is the rest of the world, both in terms of the level of the ratio and also the steady improvement that has actually occurred since 2017. This chart shows a similar picture to the previous table. There are 2 points to emphasise here. We're now looking at both the current or initial Basel III and the final Basel III ratio. And the current and final versions of these ratios have now converged, so transition has occurred. But a key point to note is that the current ratio has adjusted down to the final ratio rather than the other way around. Secondly, you can see these spikes, and this was alluded to in the earlier discussion of counter-cyclical measures that people took, jurisdictions took during the COVID crisis. You can see the spikes in leverage ratios and then coming back down again, and this largely reflects the adjustments that different jurisdictions made during the COVID period. Okay, so that's enough for capital. Let me next turn to another fundamental element of the Basel III framework, and that is the system of multiple constraints. And by multiple constraints, I refer to a leverage ratio, a risk-based capital ratio before the floor, and a risk-based capital ratio with an output floor. This chart shows the percentages of banks by region that are constrained by the leverage ratio in yellow, the output floor in blue, and the risk-based capital ratio before the application of the floor in red. Just a point on the word constrained. It doesn't mean that elements, basically the term constrained means that elements of the framework that result in the highest level of capital. So for example, being constrained by the leverage ratio does not mean that a bank is below the minimum requirement. It just means that the leverage ratio for that particular bank results in the highest level of capital requirements. The top panel here shows data for 2017, while the bottom panel is for 2022. I think the striking issue here is how much these ratios vary both across time and also across region. And for me, I take this as a good sign of the complementary nature of the different measures and a validation of this multiple metrics approach that's in the Basel framework. And this is also something that our recent publication on the evaluation of Basel III confirmed, that all these measures are serving slightly different purposes, that they work in a complementary way rather than as substitutes for one another. If I look at some of the numbers, the leverage ratio, so on the bottom panel, the leverage ratio is the most constraining measure for about 2/3 of banks in Europe, so that's 59%, and 1/3 of banks for the Americas and the rest of the world. And this is probably most likely driven by a larger percentage of lower risk-weighted assets in Europe. Interestingly, the output floor is the least constraining measure in the Americas and the rest of the world. By contrast, in Europe, the measure that constrains the least number of banks is the risk-based capital ratio without the floor. And then finally, across all regions, the percentage of banks constrained by the output floor has considerably declined since 2017. Okay, and this is my final data slide. It shows the committee's 2 key liquidity metrics, the liquidity coverage ratio and the net stable funding ratio. The overall picture is of a very strong global liquidity position. LCR ratios are highest in Europe and the rest of the world, and across all regions, the liquidity buffers have been well above 100%. There is greater variability in the LCR ratio in Europe in terms of across time, but this could also be interpreted as a good thing in terms of banks using these buffers, which is part of what's expected in terms of the Basel framework. And in the right-hand panel, looking at the net stable funding ratio, I think the key message here is that globally, these ratios have tended to converge now at about 120 to 125%. Okay, so that concludes my very short tour of the global Basel III monitoring data. Overall, I think the picture is one of a vastly more resilient banking sector since the great financial crisis, both in terms of capital and liquidity. I think that provides banks and supervisors with a strong foundation to respond to shocks and to manage the emerging risks. Okay, so with that, let me switch gears a little bit and talk a little bit about the committee's work program. And I'll say a few remarks about each element of the committee's work program. The first one is that, or the first point to make is that it's no coincidence that the first item on the committee that the committee emphasised in its 2023-24 work programme is emerging risks and horizon scanning. So this was actually, it wasn't a list that was just created at random, either in terms of the content or the ordering. So this was very much front of mind when we were thinking about the work programme, was that the emerging risks looking ahead. The impact of ongoing geopolitical developments, persistent inflation, and the sharp rise in global interest rates will bring, I think, traditional risks such as credit, market, and liquidity risks sharply back into focus. Obviously, we've already seen that, but we should be prepared for that to continue over the medium term. The second broad area of focus is on the digitalisation of finance. Here, the committee is continuing to work on a broad range of analytical, policy, and supervisory initiatives. This includes the preparation of a report that will review technological developments, including the emergence of new entrants, suppliers in the banking system, and the use of artificial intelligence and machine learning. The committee is also actively working on analysing the supervisory implications of the developments in banking as a service. Last year, we published the first global regulatory standard covering banks' exposures to crypto assets. Work is now underway in a number of areas to further develop that work. This includes the role of banks as stablecoin issuers and custodians of crypto assets, the prudential treatment of permissionless blockchains, and criteria to identify which stablecoins can be considered truly stable and therefore warrant a more favourable regulatory treatment than unbacked crypto assets. The third broad area of the work program is addressing climate-related financial risks. Work is ongoing on all three pillars of regulation, supervision and disclosure. Due to a range of reasons, data limitations, methodological gaps, and sheer uncertainty in this area, progress is, I would say, remains challenging. Nevertheless, we have and we continue to make progress. On regulation, the committee published a series of frequently asked questions or answers to those questions last year, which seek to clarify how climate-related risks can be addressed within the existing Basel framework, and work is still ongoing on other potential regulatory measures. In the area of supervision, the committee will monitor the implementation of its principles for the effective management and supervision of climate-related financial risks, which is a paper we published last year. And banks' transition planning and the effective use of scenario analysis are also important areas of focus for supervision. On disclosure, the committee is coordinating closely with the International Sustainability Standards Board, the ISSB, and building on this work, we seek to complement this initiative by developing a Pillar 3 disclosure framework. The aim is to consult on a Pillar 3 framework for climate-related financial risks around the end of this year. The fourth area of work encompasses monitoring and reviewing of existing standards and guidance. This covers a set of different initiatives. Probably the most important one is the update of the core principles for effective banking supervision, but it also includes things such as updating supervisory principles on banks' outsourcing practices, reliance on third and fourth party service providers as well. And an important element of this work is also reviewing the shock scenarios in the committee standard on interest rate risk in the banking book. Again, that was something we decided to do last year rather than this year. The fifth and final area of the work program is implementation and evaluation. The full, timely and consistent implementation of Basel III remains a high priority for the committee. In practice, this means monitoring the status of Basel III implementation across member jurisdictions, and in due course also assessing the consistency of those standards with the Basel framework. And this is done through a very rigorous process which we refer to as the Regulatory Consistency Assessment Program. And as we've done this past year, the committee will continue to evaluate the impact and efficiency of Basel III as jurisdictions implement the standards. So let me conclude by saying we know that the regulatory framework can always be improved and needs to adapt to market developments and innovation. We also know that it takes more than a good regulatory framework to ensure the soundness and safety of global financial institutions. So with that, I will stop. Thank you very much.
Thank you very much, Mr. Esho, for crunching all those numbers for us.